right.
Hi everyone, welcome to the webinar. We're just going to give you all a few minutes to get settled in before we start, so feel welcome to do whatever you need to make yourself comfortable, grab a drink or something, settle in. And there's also a link to a pre-survey for this webinar in the chat, so if you have a moment and could fill that out, that'd also be really great. Just getting some feedback helps us continually create these webinars that provide you with information you need most.
Right. So Lindy, do you want us to get started?
Yeah, go ahead, Deb.
All right. Welcome, everyone. So I'm Deb Clinton. I'm the Communication and Programming Specialist with Mo Money, Financial Literacy Resource Center, and I'd like to welcome you all to Investing Basics. I'm going to pass, I guess, the microphone over to my colleague, Alexandra Rodriguez, and she's going to take it from here. Thank you.
Thank you, Deb. Okay, so again, good day, everyone, and thanks for joining us for today's session. As that said, my name is Alexandra, and I'm the Money Counselor at the Mo Money Financial Literacy Resource Center. So the Mo Money Financial Literacy Resource Center and the Mohawk College Alumni Association, in partnership with the Canadian Foundation of Economic Education and the National Bank of Canada, have created this series of Mohawk College student-facilitated financial literacy webinars. We call them the Wealthing Wednesdays. So welcome to the second one of this series, Investing Basics. Sorry, my computer is just not working. So I just want to say that this session is delivered from my home in Hamilton, Ontario, on land very close to Mohawk College. So I like to take this opportunity to acknowledge that my home and the college are situated on the traditional and unceded territory of the Haudenosaunee and Anishinaabe nations within the lands protected by the Dish with One Spoon, One Spoon agreement, and is currently home to many Indigenous people from across Toro Island. So now let's talk a little bit about Mo Money. Mo Money is here to help. At Mo Money, we are committed to helping students improve their money skills. To accomplish this goal, we host events, workshops for groups, and we also have individual appointments where you can meet with myself with the money counselor and talk about your specific financial situation. We have also developed some financial resources to support students in their path to develop financial literacy skills. We have many ways that you can get involved with Mo Money. Here you can find some of them. You can follow us on social media or on Instagram or Facebook. We also created the Money Matters module that is a free course on My Canvas. In this module, you can learn about budgeting, starting a business, making big purchases like cars or houses, how to manage your debt, and much more. What are the benefits of attending our workshops? So the first benefit is the co-curricular record. So the CCR is a tool for students to track this experience or any program or event not formally related to a program of study. So the CCR can be used on and off campus when applying for jobs, awards, and scholarships, and to build resumes. Just like an academic transcript, the co-curricular record is verified and approved by Mohawk College staff. The CCR is then stamped and signed by the Vice President, Students, International, and Alumni to acknowledge students' non-academic contributions to their campus and community. The CCR can be downloaded and attached to an application to draw attention to demonstrated skills and experiences. You need to register your attendance. I'm going to leave you the link in the chat and just enter the code MoMoney4Me. And you can also have chances to win prizes. CFE has been very generous in offering a chance for participating students to be entered into a draw to win a 100,000 gift card from Tim Hortons. As well, if you attend 4 out of the 5 sessions of these Wealthy Wednesdays, you will be eligible for a financial advocacy badge, and also your name will be entered into a draw to win $200,000 in cash. Okay, now I'm just gonna pass it to Lindsay from Alumni, who is going to share with you some important information.
Hello, everyone. Thank you, Alexandra. My name is Lindsay Diamond. My pronouns are she and her. I work in the Alumni Relations Office as the Career Transition and Development Coordinator. The Alumni Association is your link to Mohawk College, Mohawk College community after you graduate. You can connect with alumni on all of our social media platforms, as you can see on the screen there. As a student or a graduate of Mohawk College, you are welcome to participate in all of our events that we host. Now, we host a wide range of events, such as social events like trivia nights, tea tasting. We do lots of career development workshops and webinars, personal development workshops, and many more. For the students in our audience that are graduating this April, I encourage you to check out our grad send-off page. You'll be able to enter contests, register for your grad gift. We have more events that are posted there that are geared towards that transition from life at college to after college. I will put that link in the chat for you afterwards. And then also for any alumni that are in the audience, I encourage you to download our Alumni Perks app, which is exclusive for Mohawk alumni, where you're going to get lots of discounts, contests, as well as our events are posted there. So that's enough about alumni for right now. I look forward to learning aside everyone this afternoon. So our feature presentation, I'd like to pass it over to Lindy, our alumni facilitator and the CFEE staff for Investing Basics. Enjoy.
Thanks so much. Okay, I'm just going to take a moment to share my screen. Okay, I hope everyone can see that. So, hello, and welcome to the Investing Basics workshop. My name is Lindy, and I'm a recent Mohawk College graduate. Today, we're going to talk about investing basics. The goal of today's presentation is to provide you with foundational knowledge necessary to begin investing. You will leave this presentation more knowledgeable about investing and hopefully also more confident. This workshop will last about an hour, and then we will have a Q&A period at the end of the presentation where you can ask any questions you have. We also sent out a pre-survey, and there will be a post-survey sent out at the end of the session. If you fill out both surveys, then you'll be entered into a draw for one of two $100 Tim Hortons gift cards. Your feedback helps us improve our workshops and make them more helpful to you. So we'd really appreciate it if you are able to complete the surveys. Okay, so first, a little about this program. CFI and the National Bank have partnered to offer financial literacy workshops to post-secondary students across Canada. Finances impact our lives in many ways, so we want to provide you with information that will help you better navigate your finances in a more empowering way. In 2020, we surveyed 1,500 students to learn about what they want to learn more about in regards to financial literacy. Here's some information that we found out. Some of the priorities students identified in the survey are investing for the future, learning to deal with financial stress, and building a financially healthy life. We hope today's presentation will provide you some information around these topics. Today's module is focused on the basics of investing to ensure you leave with knowledge that is helpful as you start your investment journey. The presentation has been broken down into 3 parts. In the first section, Why Invest? We'll discuss the importance of inflation, the differences between saving and investing, and an introduction to compound interest. Okay, next we'll talk about the different types of investments and how each one grows over time. Finally, we'll talk about how important it is to invest efficiently. That means being aware of the various investment accounts and how taxes can impact your investments. Before we get started, just a gentle reminder that while investing can seem complex or overwhelming, the basics are all you need to get started, hence why we're covering the basics today. Coming out of this workshop, you will have learned the foundational skills that allow you to invest with confidence, as well as why it's important to invest for your future to help outpace inflation. You'll also learn about what basic investment asset classes exist, and you'll know the various account options there are for investing. To start off, it's worth mentioning that when it comes to investing, there's a fair amount of jargon. Today, we'll learn more about some of these terms and what they mean, so that you'll feel more comfortable with the language around investing. Let's do a quick poll to determine how familiar folks are with investing terminology. So if someone could set up the poll, that'd be great. If you could all just answer the question, to determine how familiar you are with the terms on the slides, that'd be much appreciated. I'll just give folks a moment to do that.
Okay, we've had most of the people respond, so let me just. You see the results, Lindy?
Yep, can everyone see the results? Yeah, so it seems like everyone here is familiar with some or most of the terminology, which is really great. So it shows that you've already been exposed to some investing terminology, and hopefully that will help with understanding this presentation as we go along. All right, so why invest? The role of investing is to use the money you currently have to increase how much money you will have in the future so that you can better achieve your future goals. In this section, we'll discuss the importance of inflation and how it affects your money. We'll also discuss the difference between saving and investing. And finally, we'll look at how compound interest helps your investments grow exponentially over time. These are some important fundamental topics, so let's get started. Inflation causes prices to rise over time, which means your money today will be worth less in the future. Various factors influence inflation, and inflation can sometimes be a positive sign of a growing economy. So, how does inflation affect you? Over time, the purchasing power of your money will decline, meaning you'll be able to buy less with the same amount of money. For example, you might have noticed the price of groceries increasing over the past few years. That's an example of how inflation shows up in our lives. Let's take the example of a loaf of bread. In 1970, a loaf of bread might have cost about 25 cents. Today, it costs closer to $2.50. So let's imagine that in 1970, you put a quarter into a piggy bank. Then you waited until today to take that quarter out to buy a loaf of bread. However, today, you would no longer be able to purchase a whole loaf of bread with only a quarter. That's why it's important to invest your money to ensure that it grows, so you'll be able to afford the same standard of living in the future. If you're saving money without any interest, then you're technically losing money over time because inflation is reducing the value of your money over time. Canada's annual inflation rate generally ranges between 1% to 3%. If you want your savings to keep up with inflation, then you would need to earn at least 1% to 3% annual interest on your savings. The average inflation rate in 2021 was 4.4% and is currently sitting at 4.8%. This is a 30-year high. With inflation numbers higher than average, it's really important to consider how you invest to account for that inflation. The first step to investing is to make sure you have savings. Saving means holding on to some of your money to use in the future. Investing is what you do with your savings. Investing is not only for people with lots of money. Anyone who has savings can make decisions about how to invest those savings. A regular savings account is one of the safest places to put your savings. Canada's banks are very sound, and you don't take on a lot of risk by putting your money into a regular savings account. However, while a savings account is very low risk, it also means that you'll get a very low return. This is one of the most important lessons to learn early on about investing. Low risk will mean a lower return. Later on in this presentation, we'll look at some alternatives to putting your money in a regular savings account. Let's compare the following 3 examples to get a better understanding of the importance of investing. Conservative Carl decides to hold their money in cash. Over the long run, they will lose money because inflation will reduce the $30,000 purchasing power, meaning Carl will be able to buy less with $30,000 in the future as opposed to today. Save Sam decides to put their money into a savings account offering a 1.5% interest rate. Over the long run, the interest gained in the savings account will make up for the inflation. Therefore, in the long run, the value of their money will remain the same. Incredible Ingrid decides to put their money in an investment, earning a 5% interest rate. Over the long run, they will grow their original investment, even with inflation included. This is because inflation tends to be around 1% to 3% per year, whereas Ingrid is earning 5% interest each year. Real return refers to the return one earns after adjusting for inflation. In this example, only Ingrid is earning a real return, since the 5% annual interest rate they earn beats out the 1% to 3% inflation rate. The magic of compounding refers to how savings and investments can grow in value more quickly because of compound interest. Let's watch this video that talks about the difference between simple interest and compound interest, and illustrates the impact of compounding over time.
Let's assume a very generous bank offers to pay John and Lisa a return of 10% per year, and they each invest $1,000 called the principal. John wants to spend the interest each year and only keep the principal in the bank, while Lisa wants to save for 30 years, so she doesn't take the interest out each year. In John's case, the 10% amount to $100 each year. So after 1 year, he'll have $1,100 in his account, out of which he'll take $100. After the second year, he'll once again have $1,100 in his account, out of which he'll take $100. After the 30th year, he'll have $1,100 as usual and take $100. He will be left with $1,000 in his account. So his principal and the returns he made amount to $100 multiplied by 30, so another $3,000, a grand total of $4,000 that he made over 30 years. Lisa, on the other hand, will make more. After 1 year, she will have $1,100 in her account, but she keeps everything there. After the second year, she will earn 10% of those $1,100, and not only on the initial $1,000. Therefore, she will have $1,100 plus $110, so $1,210. After the third year, she will earn 10% of those $1,210 and have $1,331. After year 30, she will have $17,449.40, over 4 times more than John.
All right, I hope that video was helpful. So just a quick note, a 10% interest rate is actually very high and it's not typical for investments, but the video uses it as an example because it makes the math of compound interest easier to understand. So a common question is, what can I invest in to earn compound interest? The answer is anything. Many investments offer the opportunity to earn compound interest, and we'll be exploring some of those different investment options in this presentation.
Let's assume.
As you saw in the video, the magic of compounding refers to how savings and investments can grow in value more quickly because of compound interest. If you start investing at a young age, you'll have many years for your money to grow through compound interest. Now, let's take a look at this chart to really see the significance of compound interest. The 2 lines represent 2 investors who invest the same amount of money over time. The blue line investor earns simple interest, whereas the red line investor earns compound interest. If you look at the simple interest line, you'll notice that the growth is linear. This is because the same amount of interest is being earned each year, and the interest earned each year is being removed from the account and not being allowed to grow. If you look at the compound interest line, you'll quickly notice that the growth is exponential. Here we see just how powerful interest on top of interest can be. Even though the red and blue lines start at the same place, over time, the red line's earnings begin to heavily outweigh the blue line's earnings. This is because the red line is earning interest on top of the interest they made from the previous years. And as time goes on, this growth becomes more pronounced. We've now seen the magical effect of compound interest, but remember, it takes time for compound interest to really pick up pace. In this slide, we'll be looking at just how important it is to start early. Even a few years can make a big difference on your investment portfolio size. In this example, we have 2 investors earning 8% interest compounded monthly. Let's say the first investor, Early Bird Earl, who is represented by the green line, has decided to start early and invest $100 a month from age 21 to 41. At age 41, they stop contributing money to their account and let compound interest take over entirely. By age 47, the account has grown to over $400,000. On the other hand, procrastinator Pat, who is symbolized by the blue line, starts late and invests $100 a month from age 47 to 67. By the time they turn 67, their original investment of $24,000 will have grown to a total of about $59,000. Keep in mind, both these investors added the exact same amount of money to their account, $24,000. The only difference is that Earl started early, allowing compound interest to take a much larger effect on their account. A key takeaway is that it can be beneficial to start investing early in your life, So your money will have time to grow and your future self will have more money. Ever wonder how long it will take your investment to double? The rule of 72 can be used to calculate roughly how many years it will take your investment to double. To calculate, divide 72 by the interest rate you're receiving. For example, if you earn 2% a year, it will take 36 years for your money to double, because 72 divided by 2 equals 36. This can also be used to determine how much inflation will hurt your purchasing power. For example, if inflation is 2% a year, then the purchasing power of $1 will be cut in half in 36 years. If inflation is closer to 12% a year, like it was in the early 1980s, then the purchasing power of $1 will be cut in half in 6 years. The rule of 72 is a useful concept to keep in mind in relation to the concept of compound interest. All right, let's take a look at our key takeaways. First, earning more than inflation is important. Over time, the purchasing power of money decreases, which means the money you have today will be worth less in the future. Therefore, in many instances, it's best to earn some sort of interest on the money you save in order to keep up with inflation. Second, you can't invest if you don't have savings. Once you have savings, you can make decisions about how to invest them. That means in order to start investing, you need to find small ways to set some money aside each month for the purpose of ultimately investing in you and your future goals. Finally, when should you start investing? The answer is right now. When it comes to investing, you want time on your side, which will allow for the magic of compounding to really help grow your investments. Next, we'll be covering different types of investments and how they make you money. The goal of investing is to let your money work for you. It's important to learn about the different types of investments so you can find out which ones are best for you. We'll be looking at some alternatives to a regular savings account. And although you can invest in many different things, there are 3 general types of investments that we'll be going over. The first category, or asset class, is cash, or close to cash, or cash equivalent investments. These investments are very liquid and are low risk, but also provide a relatively low return. Examples of these types of investments are things such as cash, bank deposits, term deposits, and guaranteed investment certificates, also known as GICs. In each case, this form of asset rewards the investor with interest. You can buy a GIC at a bank. The GIC is guaranteed to pay a certain interest rate over a certain period of time. It's very safe and usually pays more than a savings account. Another form of liquid investing is to open a high interest savings account. If you're thinking of opening this type of savings account, a helpful tip is that you'll tend to get a better interest rate at major banks. Also, up to $100,000 in deposits with any Canadian regulated financial institution or bank is covered by insurance, which means that your money is protected if anything happens to the bank. As we discussed before, the amount of risk is connected to the interest rate you'll receive from your investments. Lower risk investments like GICs will tend to have a lower interest rate, whereas a loan that is considered higher risk will have a higher interest rate. The second common type of investment asset class is fixed income investments, also known as bonds. Bonds are essentially a loan that you make to a government or company. Unlike cash equivalents, you can buy and sell bonds in the bond market, the same way that you can buy and sell stocks in the stock market through a broker. You can also get exposure to fixed income investments through balanced funds. Balanced funds can be mutual funds or exchange-traded funds, and often have a mix of equity and fixed income investments to help balance your risk. The market price of a bond will change in the bond market over time. In this way, even though bonds provide fixed income, which is a fixed rate of return, they can be bought and sold in the bond market at different prices. Based on what happens to interest rates, a bond's market value may rise or fall. If interest rates drop, the bond's price will increase. If interest rates increase, the bond's price will fall. Interest rates are at low levels, and so the price of bonds will tend to be dropping over the next few years. The longer the term of a bond, the more the price will drop if interest rates increase. In the end, though, whoever owns the bond when it matures, which means when the bond term is up, will be paid back the principal by the company or government that issued the bond and borrowed the money. You can decide then what you want to do with the money and if you want to reinvest it. So fixed income investments provide a fixed rate of return for a particular period of time if you hold the investment until maturity. Another popular asset class is equities, which means buying a share of ownership in a company. If the company does well, the value of the shares or stock should rise. A higher stock price indicates that the value of the company is higher. Equity investments, like stocks, are riskier than fixed income investments. Their value is more volatile and less predictable. A stock's value may rise or fall, sometimes by a great deal. The possible return on an equity investment is higher, but so is the risk of loss. Equities provide investors with value in one or two ways. The first is capital gains, which is the rise in the value of the shares, meaning the shares become worth more than the price they were purchased at. Keep in mind that the gain is not real until the shares are sold. For example, let's say you buy 100 shares of a stock for $10 per share, and then you sell the stock for $15 per share, for a total of $1,500. You have a $500 realized capital gain because $1,500, which is your sale price, minus $1,000, which was your purchase price, results in a net gain of $500. Right, so secondly, some equities also pay dividends, meaning essentially you get paid for owning a stock. Because you're a shareholder, the company whose stocks you bought give you a portion of the profits they make. Sometimes these dividend payments are worth pennies per share. It may not sound like much, but these dividends can add up over time. As an example, let's look at an individual stock. This is not in any way a particular recommendation for any stock, but rather just an example to look at how dividend yields work. So the stock of National Bank pays shareholders a dividend. So each company will choose how much of a dividend to pay. As of March 14th, 2022, which was a few days ago, National Bank is paying 87 cents per share in quarterly dividends for a total of $3.48 per year. Based on the current share price of $99.14 per share, that works out to a dividend yield of 3.56%. National Bank has chosen to pay its dividends quarterly in 4 installments over the year. Other companies may choose to pay their dividends monthly, which means 12 installments per year. These dividends can provide a steady stream of income, especially when you're either in retirement or between jobs during your career. However, these dividends are in no way guaranteed, and they can go up or down. Usually, though, a company that is doing well will typically increase their dividend income paid per share over time. Besides equities, fixed income, and cash and equivalents, here are a few other popular investment types. Let's talk about funds, and in particular, 2 popular types of funds. The first type is a mutual fund, which is when investors pool their money together, and then that cumulative sum is invested and actively managed by a professional. You don't need to personally go find other investors to pool your funds with. There are fund companies that will do this for you. Investors can buy units of a fund that they want to invest in. Keep in mind that the value of the units can change according to how well the investments in the fund perform. If the unit value rises, the value of your investment in the fund also rises. But if it falls, then the value of your investment also falls. There are many different kinds of funds offered by many different companies. For example, a fund might invest only in equities or only in Canadian equities. Another fund might only invest in government bonds. The list goes on, and there are thousands of different types of funds. You will pay a fee to professional and the professional's company for managing a fund. Funds can have different kinds of fees, so make sure that when you invest in a mutual fund, you know what fees you're paying. Many mutual funds in Canada charge about 2% per year, multiplied by the assets you have invested into the mutual fund. Next, we'll look at exchange-traded funds, also known as ETFs. Like mutual funds, ETFs are pools of investors' money that is then invested as a cumulative sum. Just like mutual funds, investors can buy units of an ETF, but because they trade on the stock market, they are actually shares of the ETF. Again, the value of shares changes according to how well the investments in the ETF perform. If the share value rises, the value of your investment in the ETF rises. If it falls, then the value of your investment falls. There are many different kinds of ETFs offered by different companies. Just like mutual funds, some ETFs might invest only in equities or government bonds or so on. You will also pay a fee to a professional or company that manages the ETF. However, it will be a lower fee than a mutual fund. Mutual funds are mostly actively managed, meaning a manager or a management team makes decisions about how to invest the fund's money in an attempt to achieve the fund's stated objectives. Mutual fund companies typically try to outperform the market. However, most ETFs are passively managed, meaning that the fund is meant to mirror an established index or market. As a result, ETFs generally charge much lower fees because there is less research required to manage them. As an example, let's say you have a choice between buying a mutual fund share where you can pay 2% in annual fees, or you can buy an ETF fund where you only pay 0.06% per year in fees. The mutual fund manager must outperform the index by close to 2% to make it worthwhile to hold the mutual fund, as opposed to the ETF, if you are comfortable investing in the ETF yourself. At the end of the day, each of us has to find our risk and return balance point. It's important to have a sense of your attitude to risk when it comes to investing. What level of risk are you comfortable with? What level of risk will let you sleep at night without worrying? And what level of risk do you need to take, or are you willing to take, to reach your goals? Everyone's risk and return balance point will be affected by many factors, such as, first of all, your time horizon, which is how long before you need to use the money from your investments. If you need the money from your investments in 2 years for education, you won't want to take on too much risk and likely won't want to put any money into the stock market. A useful rule of thumb is that you should only put money in the stock market if you don't need it for over at least 5 to 10 years. For example, someone who doesn't need their money until retirement in 35 years will likely be willing to take more risk. Another factor that influences your risk-return balance is your age. For example, younger folks tend to be better able to accept higher risk than older folks, since younger people have a longer time to recoup losses through the income they earn in their career if the value of an investment falls or if they lose on an investment. A Third factor that influences your comfort level with risk is your wealth and how much you have to invest. People with more wealth tend to be in a position to better accept more risk because it's easier for them to afford a loss. Another factor that influences your comfort level with risk is your goals and how much you are hoping to earn from your investments in order to realize your goals. If you set a certain goal and find out that you will need an average return of 10% on your investments to reach your goal, are you comfortable with that level of risk? If not, you might have to change the goal or set a longer date to give yourself more time. So, another quick poll. Let's imagine you decide you would like to buy and sell stocks as one of your investments. If you haven't had a lot of experience investing in the stock market, you might decide to work with a broker. Let's say you tell your broker that you have some savings and you would like to achieve the following. You want your investments to make a 20% return each year, and you don't want to run the risk of losing any more than 5% of the value of your savings. Is this a reasonable thing to ask on your part? Yes or no? I feel welcome to take a moment to share your thoughts in the poll. All right, thank you all for sharing. So yeah, interesting to see there's a balance of thoughts. So some folks thought yes, some folks thought no. So let's delve into what the answer is and why it is that way. So the answer is that no, unfortunately, it's not a reasonable request. It'd be great if we could get so much reward in return with so little risk, but remember an earlier principle that we talked about. So the thing is your potential risk on an investment and your potential risk for, so your risk for the rate of risk and return have to be in balance essentially. So if you want your investment to provide a possible 20% return, you have to accept the risk that your investment may fall 20% in value or more. The higher your target return, the more risk you have to be willing to take. If the possibility of losing 20% of your savings is more than you're comfortable with, then you might have to lower the target for your potential return. And also, heads up that a 20% return in 1 year is also quite high and quite difficult to achieve. So key takeaways in summary. So we learned about how there are 3 main asset classes: cash, fixed income, and equities. We learned about how mutual funds and ETFs are great ways to get started in investing. Both provide an instant diversification by investing in a pool of assets. Mutual funds are more expensive than ETFs, so make sure you understand the fees and are comfortable that you are getting good value for the money you're spending. Finally, remember that there's always a fairly direct connection between risk and return. If you're looking to minimize your risk, then expect to see a lower return. And if you're looking to maximize your returns, expect to face higher risk. Understand your goals for investment so you can choose the investments that will best help you meet your goals. It's important to invest efficiently, especially when you're first starting out. You want every dollar you invest to be used to its maximum potential. In this section, we'll look at how you can invest efficiently to maximize your earnings. When it comes to investment accounts, there are 2 general types. We'll review the differences between registered and non-registered investment accounts. Then we'll focus on some specific account types, in particular, TFSAs, tax-free savings accounts, and Rrsps, registered retirement savings plans. Both accounts offer tax advantages to help you reach your savings goals. And if you can afford it, it's a good strategy to contribute as much as you can to both. We'll also look at how non-registered accounts can take away from your returns because you have to pay taxes. Finally, we'll discuss seeking advice and how to develop your judgment to make better money decisions. There are two types of investment accounts, registered accounts and non-registered accounts. You can think of these investment accounts as containers that can hold all sorts of investments. You could keep cash equivalents, fixed income assets, equities, and even mutual funds and ETFs in your investment account. A registered account is an investment account that is given tax-deferred or tax-sheltered status by the government. What that means is that income earned in the account, like capital gains or dividends, are not taxed until withdrawal, or in the case of a TFSA, are never subject to taxation. In order to ensure that registered accounts are used for their intended purposes, the government puts some rules into place. For example, a limit on how much you can contribute to the account. A non-registered account does not enjoy the same tax-sheltered status as its registered counterpart. These are general investment accounts, where you can invest in a wide range of assets and are required to pay taxes annually on the income generated by the account. Investors appreciate non-registered accounts for their flexibility because they don't have any contribution or withdrawal limits. A common type of non-registered brokerage account is a cash account. Cash accounts are investments in which income is taxable in the year earned if there are capital gains, dividends, or interest income. If you have already maxed out your registered accounts, TFSA, and possibly Rrsp, depending on your income, a non-registered account allows you to continue investing. A general rule of thumb is that if your annual taxable income is less than $50,000 per year, a TFSA makes a lot of sense. But it might not make as much sense to contribute to an Rrsp. And a non-registered account might make more sense once you have fully contributed to your TFSA. Non-registered accounts are Canadian investments accounts which can be taxed. As a rule of thumb, you can expect any form of savings in this account to be taxed. 50% of your capital gains are taxed in a non-registered account. The tax rate depends on your personal tax bracket. For example, if you're in the highest tax bracket in Ontario, you would pay about 27% tax on capital gains. 100% of the interest you earn in a non-registered account is taxed. Once again, the tax rate will vary based on your personal tax bracket. If you're in the highest tax bracket in Ontario, you'd pay about 54% tax on interest income. When it comes to dividend earnings in a non-registered account, you will be taxed based on your personal tax bracket once again. Qualified Canadian dividends are eligible for a 15% federal dividend tax credit, along with a provincial tax credit, which in Ontario is an additional 10% tax credit. These tax credits will reduce your effective tax rate. If you have less than $50,000 in annual taxable income, you may actually be charged a negative tax rate on dividends due to tax credits in Ontario. So as an example, investors in the highest tax bracket in Ontario pay a tax of about 39% on dividends, compared to 54% on interest income and 27% on capital gains. As you can see, a non-registered account means your investments will be impacted by taxes. In most cases, it's not the best idea to open a non-registered account when you're just getting started with investing. Investors tend to open a non-registered account only after they have filled the contribution limits of their TFSA and Rrsp if they're in a higher income bracket. Now, we're going to take a deeper look at how effective registered accounts can be at helping you save money. A useful investment account is a tax-free savings account, or TFSA. You can use a TFSA for any savings goal, short-term or long-term. Many people like to describe a TFSA as a storage container, and you can store all types of investments in it. For example, you could put in cash, GICs, bonds, stocks, mutual funds, and ETFs. And the best part is, all these investments grow tax-free inside the TFSA. What that means is that you won't have to pay any capital gains taxes or income taxes on your investment's growth. And this can really make a difference over time. Remember the magic of compound interest. Finally, as an added bonus, you also won't pay any tax on withdrawals from your TFSA, so you can move money in and out of the account without any tax consequences, as long as you follow the rules. However, if you take money out of a TFSA, you can't replace it until the following year. There are contribution limits to a maximum amount each year. For example, the limit is $6,000 in 2022. Otherwise, everyone would probably put all their investments in a TFSA because it's a great deal. Here's some good news though. Let's say that you can't make a full $6,000 contribution in 2022. Don't worry, you can put in the difference plus the following year's limit in the next year. That's because the contribution limit is cumulative, and so unused contribution room rolls over from one year to the next. You can find out how much contribution you have in your TFSA by making a CRA My Account. For Canadian residents who were 18 when TFSAs were introduced in 2008, you could put away $81,500 in a TFSA right now if you haven't made any contributions yet. Another notable investment account is a Registered Retirement Savings Plan, or RRSP, which is meant to help your investments grow tax-free until you're ready to retire. Investments that can be held in an RRSP are called qualified investments. They include cash, GICs, bonds, mutual funds, but the mutual funds have to be RRSP eligible ones, ETFs, and equities. By using an RRSP, you get immediate tax relief because you get to deduct your RRSP contributions from your income each year. You don't get that tax deduction with TFSAs. Effectively, with the RRSP, your contributions are made with pre-tax dollars. The money you make on your RRSP investments is not taxed as long as it stays in the account. You'll pay tax on your RRSP savings when you withdraw money from the account. The tax will apply both to your investment earnings and your contributions. The purpose of an RRSP is to be a place where you invest your money once you are earning enough to enter a higher tax bracket. By putting money into your RRSP when your taxes are high, you're able to decrease the amount of taxes you pay. The benefit of this becomes pronounced if you then leave the money in the account to compound until your retirement, when your taxable income should be lower than your working days. For example, earlier in your career, you might have paid a tax rate of 33 to 43%. However, during retirement, when your annual income is lower, you may only be taxed at around 20%. That's as much as a 23% tax savings on your taxes. When combined with compound interest, RRSPs can be a great investment strategy when you are in a higher income bracket. Your RRSP contribution room also accumulates each year based on your annual income. For 2022, the maximum contribution is 18% of your earned income, with the maximum contribution amount of $29,210, less your pension adjustment. You can find more specific details on the Canada Revenue Agency website. This chart highlights a few of the important distinctions between different investment accounts. A TFSA can be contributed to without any income, whereas you can only place a percentage of earned income into an Rrsp. Contributions to a TFSA are not tax deductible, whereas contributions to a Rrsp are. You can withdraw from a TFSA without paying any taxes on the withdrawn amount, unlike a Rrsp. If you don't use your annual contribution room in either a TFSA or Rrsp, it accumulates. Also, it's worth pointing out that you can continue to use a TFSA for tax-free investment growth your entire life, whereas money in a Rrsp must be transferred to a different account after the age of 71, because Rrsps are meant to help you save for retirement. It's important to realize that making effective money decisions can benefit from help and advice. Find trusted and reliable sources to assist you. Understand the importance of checking the qualifications of anyone claiming to be able to assist you financially, and ensure you are informed about all related costs, terms, and fees associated with any financial advisor before becoming involved with them. It is possible to do your own investing with help from banks and online brokerages. However, although you might pay a fee to work with an advisor, it might also be worth it. This can be true, especially if you don't know a lot about investing at the moment. An advisor may be able to help you get the return you're looking for, even taking into account the fee you pay for their help and advice. Whether you seek an advisor's assistance or would prefer to do it yourself, it will always be important to set goals, work through your comfort with risk, pick appropriate investments, diversify, and put together a financial plan. Finally, be aware that all stocks must be bought and sold through a licensed broker. A broker is someone who is trained and has a license to buy and sell stocks. This may be a broker that you can pay a fee to get help and advice. Or it may be an online brokerage company that lets you make your own buying and selling decisions. You'll pay a lower fee if you make your own decisions, but you also won't get any advice in that case. Developing your judgment takes time, and it's important to understand that this is a learning process rather than something you pick up in a few days. Take all the information you learn and then use the information you have to make better money decisions. Always verify your knowledge by referring to multiple sources. For instance, if you want to learn more about ETFs, consider comparing multiple sources rather than just taking information from one source. Free knowledge is usually readily available on the internet, so use your judgment to pick out information from reliable sources. So some of the key takeaways from this section are that everyone should have a TFSA, that taxes impact your returns, so it's important to use investment accounts to your advantage, and that developing your judgment to make better money and investment decisions is a process. So be kind to yourself as you're learning, and don't be afraid to seek advice. So let's quickly review what we've learned today. First of all, understanding inflation and the importance of earning more than inflation is important. Remember, inflation means that the money you have today will be worth less in the future. Therefore, investing is a great way to keep up with inflation when you're looking to store your money. Second, you can't invest if you don't have savings. Once you have savings, you can make decisions about how to invest them. This means that in order to start investing, you'll need to find some small ways to set money aside every month for the purpose of ultimately investing in you and your future goals. Third, when should you start investing? The answer is right now. When it comes to investing, you want time on your side, which will allow for compound interest to really help grow your investments. In summary, for types of investments, we learned about 3 main asset classes: cash, fixed income, and equities. It's important to understand the difference between these types of assets so you can figure out what works best for you and your risk level. Mutual funds and ETFs are great ways to get started in investing. Both provide instant diversification by investing in a pool of assets. Mutual funds are more expensive than ETFs, so make sure you understand the fees and are comfortable that you're getting good value for the money you're spending. Finally, remember that there is always a fairly direct connection between risk and return. If you're looking to minimize your risk with investments, then also expect to see a lower return from those investments. On the other hand, if you're looking to maximize your returns, then make sure you're comfortable with the amount of risk you're taking on. So key takeaways for investing efficiently: open up a tax-free savings account. It will really help with tax savings and with your investing journey. Look into TFSAs, ask about them, and think about if they would really work for you. Another thing is that taxes eat away at returns. So remember all the taxes associated with non-registered accounts and think about that as you're investing. And make sure to take advantage of registered accounts so you can take advantage of those tax savings. Finally, develop your judgment. Don't be afraid to seek advice. And remember that everything is a learning journey. So coming out of this workshop, I hope you feel that you've learned the foundational skills necessary to invest with confidence and why it's important to invest for your future to help outpace inflation. I hope that you've learned a bit about the basic investment asset classes, which exist, which are cash, fixed income, and equity. And I hope you also know more about the various account options there are to investing. For example, registered accounts like the TFSA and Rrsp, as well as non-registered accounts and how taxes impact your investments. Here are some next steps that you might want to consider. You could set up a practice trading account at a discount brokerage and go through the motions of investing, which involves doing your research and finding out which investment options would work best for you and your goals. You may also want to consider talking to a financial advisor about investing. One of the simplest ways to do so is through your bank. You can also research your options and find a financial advisor or financial advisory firm that you feel comfortable with. Another thing, you might want to set up a TFSA if you haven't already set up one. You can open a TFSA with a bank, credit union, or insurance company, but you can also do so with a financial advisor. And finally, feel welcome to check out additional CFE program resources. For example, there's another investment webinar being offered next week, and I believe Deb will speak a bit about that shortly. So just before we wrap up and move on to questions, here's a few final tips for investing. First of all, don't panic if things don't go well. Stay calm and do your best to avoid irrational decisions. One key item to be aware of is to keep in mind your time horizon and only invest money in riskier investments that you don't need to access for at least 10 years. For example, when the market fell sharply in 2008 and 2009, it recovered most of its losses in the year or two after. Also, the market drop in early 2020 was fully recovered within the year. Those who sold their investments when things went bad lost money. Those who held on and didn't panic, in many cases, got their money back. Next, remember to keep inflation in mind when making your investment decisions. You'll want to earn a rate of return that is at least equal to the rate of inflation. Otherwise, you could be losing money. So if, for example, if the inflation rate is 2% and your investment is only paying you 1.5%, then that's a loss of 0.5%. So definitely keep inflation in mind as you look at investment options. And the final tip is to invest, even in small amounts. You'll be surprised how small investments can add up over time. Remember in our example of compound interest, maybe something like $2,000 a year may not seem like much, but after decades of compound growth, it could grow into a very significant sum that could go a long way to helping you reach your future goals. To conclude, it's important to start investing today or as soon as you can, so that you'll have money to achieve your future goals. That brings us to the end of our presentation. Thank you so much for attending today's webinar. We'll now open up the floor to questions, so feel welcome to pop your questions into the chat or to ask them over audio. And also a gentle reminder to complete the surveys for this webinar if you haven't already. We sent out a pre-survey and we'll also be sending out a post-survey. And we really value your feedback so we can continue to make these workshops useful for you. And if you fill out the survey, you'll also be entered into a draw to win one of 2 $100 Tim Hortons gift cards. And so just before we get to answer questions, I'm going to quickly pass the mic back to Deb to talk a little bit about next week's webinar on investing.
Oh, hi guys. You need to let me share my screen, I think. Not sure. Da-da-da. Hi, so next week we are doing an intermediate investing on a Wednesday, and I'm just gonna see if I can share my screen. Share screen. There we go. There we go. I hope everybody can see that. I know it's not optimal, but it's build your investing knowledge, and it's going to build upon everything that Lindy showed you and talked to you about today. And I'm going to put the link to register in the chat. So it should be there. Great. And thank you very much, Lindy.
Yeah, my pleasure. Thanks so much, Deb, for sharing that. And moving on to questions, I see that we already have one in the Q&A. So Hannah asked, is it a good idea to invest in real estate? Great question, Hannah, and it's great question, Helly, and it's really great to see you thinking about different options outside of the ones we mentioned in this webinar. And so I actually believe that the webinar next week, Intermediate Investing, will be touching on real estate potentially, but correct me if I'm wrong.
Actually, Linda, yeah, the next week's we'll talk about a form of real estate investing, real estate investment trusts. So it's not directly buying a property or and renting it out and hoping for appreciation, but it's a way of investing in a pool of real estate that you could get the returns from renting and capital appreciation as well. So it is a real estate investment trusts are a form of investing into real estate.
Yeah, thank you, Craig. And also, I guess to answer the question of whether it's a good idea to invest in real estate specifically, I think the answer probably depends on you and, again, what your goals are for investing, what you're hoping to achieve. Like thinking about just your timeline, the level of return you're looking for, things like that. But if you're also curious, it might be beneficial to do a bit more research or to speak to an advisor as well.
And just one other thing to add that will be covered off next week as well in the intermediate investing is make sure whatever you're investing in, you are diversified. I wouldn't encourage you to put all of your money that you have to invest into real estate or into stocks or into one specific thing. So diversification, like buying different assets and different investments, is a great way to lower risk for yourself. And that will be covered in more detail next week.
Thanks, Craig. I see we also have another question asking, which investments should international students focus on? Yeah, great question. I mean, yeah, it's helpful to keep in mind that maybe coming into even a new country or a new market, that maybe it's a little different from your home country. And so maybe just do some additional research, think about, again, your goals and your timeline, because it's a bit hard, I guess, to say what is best for one person to focus on, because even among international students, I imagine that you all have different goals for what you want to do with your money and how you want to invest. But I'll also open up the floor if any other folks have thoughts on that question.
Yeah, maybe I'll add a little bit, Lindy, and this is something, and it's talked a lot about in Canada, but you can apply it to whatever country you're from. Be careful not to put all of your investments in your sort of home country. Again, your typical tendency is you'll invest only in the country you're from. You know that country and you feel comfortable with it, but again, you should try to diversify. So, you know, if you're coming from a different country now living in Canada, excuse me, perhaps having investments in both countries and possibly others through exchange traded funds and other things like that are a great way to diversify your risk. But no, as Lindy said, no, you know, simple one size fit all answer for what international students should focus on investing. Okay, and actually the person, looks like Lindy, the person added a bit more to the question as far as being a multi-currency country and there are no investment opportunities.
Yeah, I'm just wondering if that there was a question in there, or if that was just sort of to share the information with us to help us understand the differences in circumstances. Oh, and I also noticed that there is a question that someone asked about if this recording will be sent out or posted for viewing later. Yes, looks like the answer is yes to that. So,
Yeah, I'm just going to put the link in the chat. So you can come back in a week or two and it should be there.
awesome. Thanks so much, Deb. Do any other folks have questions?
Oh, Alexandra did. Okay, it's there in the chat.
Actually, though, Deb, that only went to the hosts and panelists. So.
Oh, okay. So I'll do it to everyone.
Yeah, I've got it.
I got it.
I think you beat me. Well done.
It was a race.
We were doing it at the same time, but you won, Deb. Well done.
Of course. So I was just wondering about that that multi-currency country. What does that mean? Like, what does that look like? Like, is that like, does anybody know what that looks like?
I'd like to hear from the person who actually posted the question, but sometimes a country will have their own currency, but it may be based upon the US dollar or something like that. So
Okay.
oh, actually the person is now putting okay, so it's a long story.
It's a long story. Okay. All right.
Hello, everyone. So my country is where I come from. It's Zimbabwe. So we have our own currency called the bond. It's called a bond note. And then we have another mobile money app that is called an RTGS. So what you do is, and then we use the United States dollar, and then we use the South African rand, and then we use the Botswana pula. So those are the monies that we use. So it's a multi-currency country. So in terms of exchange, money exchange, like the rates, our money is very inflated. So you can bring your $1, like one United States dollar, it will be equivalent to 100 bond. So the more money the more you exchange, the more it becomes inflated. So that's the bond is the currency that they use to pay civil servants. They do not pay them in United States dollars or in the South African rand. So in order for them to keep the bond still working, they are paying their workers, their civil servants, that money. So in order for you to have access to the United States dollar, you have to buy it with the bond, which for instance, if you want to buy 100 United States dollars, you have to have 10,000 bond that you have to give. So we have a bank rate, and then we have a thing called the black market rate. So the bank rate is a lot more lesser than the black market rate. So there are people who will be standing on the streets with money in their bags. So if you want, let's say South African rand, you have to buy it with the bond. So it's a multi-currency country that we use a lot of money just because we want to have that name. If someone asks me what currency do you use in Zimbabwe, I can say a bond, but it's valueless. It has a lot of inflation involved. So that is why I'm saying, like, the investment opportunities that you have is being in the black market to sell that money to people. So those are the investments that are there. So that's why I was saying it's a long story.
It's a lot. It's very complicated, but it sounds like you have a great handle on it. So thank you.
You're welcome. Thank you so much.
Yeah, and that, like, so a potential, if I'm understanding it correctly, and I definitely agree with Deb, it's very complicated, but if you had income in Zimbabwe in the bond, and you were able to move some of that over to, say, US dollars or rand and purchase investments in the US or South Africa, that might be a nice way to help diversify and help you not be hurt as much by the inflation in Zimbabwe. Like, having some investments in other currencies, especially when your income's in that local currency, can help you as far as if things move around. You should have assets appreciating in different currencies, but as you described, it's a very complicated situation, and just delve carefully as you're starting to do other investments then.
Right.
Thank you. Yes, for sure.
I see someone asked a question in the chat about the virtual attendance form and asking if there's an event code that they should put into the survey.
Right. It's if you scroll back up, I did put it in. It's Mo Money. The code is Mo Money for me. That's right up at the very beginning. I can.
It looks like the individual from Zimbabwe just typed it in there as well. So thank you for that. So
yeah.
And I apologize. I would try to say your name, but I'm sure I would really not do it justice. So apologize.
That's okay.
Right.
Any further questions from folks? Oh, I see we have another question in the chat. Is it worth it to purchase investment options in different countries? Because it sounds complicated. It is complicated. Yes, that's a great point. And yeah, I think it's really great that you're even just reaching out with this question, because, like, if you're ever feeling confused or overwhelmed, it's great to ask other folks for advice. And I might actually open the floor to see if other folks, especially from CP, have any thoughts on this.
Yeah, and definitely it can be complicated. It is a good form of diversification and a way to mitigate your risk. There's a lot of a lot of exchange traded funds out there, mutual funds, that do allow you to get exposure to different countries. So you can invest through those funds. I wouldn't encourage you to look at individual stocks in a lot of different countries, because it's a lot harder to follow those. But if you invest in some of the index ETFs, that could be a good way to get exposure to to those other countries. And, some of the bigger ETF players in Canada are folks like Vanguard, Royal Bank has iShares, Mackenzie Investments has a lot of exchange traded funds. So if you go to some of their websites and take a look at some of the different options, they'll have menus that you can drop down to look at international investments. And even within those, you can invest internationally, but possibly have them not have currency risk for you. So they'll convert the returns on the foreign index, like a US stock market index, into Canadian currencies. So you're more just getting the exposure to that other country's stocks and companies that do business there. So hopefully that's useful. But try to check out some of the various exchange traded fund offerings in Canada, and you can find ways to do that without it being too painful.
Thanks, Greg. Any further questions from folks? We have a couple more minutes left, so great time to pose any final questions. But if not, thank you all for being here and feel welcome to stay or leave.
Okay. Oh. Having a piggy bank is useless now, right? I don't know. I mean, you always hear about those people that keep coffee cans of money under their bed. I mean, at least but Lindy talked about the inflation rate. So really you're losing if you just save and not getting any return from your money. So.
Yeah, and even Canada, Statistics Canada came out with today's inflation rate. I think it was 5.7%. So unfortunately, the coffee can of money and keeping it under your mattress, you're losing money every year, as Lindy mentioned earlier. So don't take more risks than you're comfortable with, but do try to find investments that at least you're earning even a couple percent to try to maintain your purchasing power.
Yeah.
There's somebody in the chat has a question about who is the host of the event. Maybe is that one of the forums, Deb, or?
Yeah, so it's really a joint. CFI and is sort of the work behind the webinar, but Mo Money Financial Literacy Resource Center and the Alumni Association work together to sort of bring it here. And then of course, Lindy Yang was our facilitator. So I'm not sure what you're specifically asking for, but I'm hope that answered your question. Okay. Whew, good. All right. Yeah.
Well, thank you so much for the kind words, Rocky. I just noticed Rocky posted in the chat thanking us for the presentation.
Yeah. And Linda, you did a great job.
Oh, thank you. I just want to say thank you so much to CFI and Mohawk for putting all this together, and then CFI for organizing all these financial literacy workshops and creating all this great content and presentations to share with students.
Thanks, Lindy. Very much appreciate the opportunity, and thank you for everybody from Mohawk and the students who attended, and look forward to seeing a lot of you and more next week as well.
All right. Thank you.
Thank you.
Thank you so
Everyone.
much for being here, everyone.
Have a good afternoon.
I know.
Take care.
Bye.